Good morning, ladies and gentlemen, and welcome to the United Oil and Gas PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO Brian Larkin. Good morning, sir.
Good morning, and thank you for the introduction. Firstly, our apologies for the slightly late start. We had some IT issues this morning. Format for today's presentation call will be a brief presentation on the company, followed by questions that please do submit in the box on your screens. We are aware that there are a number of existing shareholders on this morning's call, but we're also aware that there is also a lot of people on the call this morning who haven't heard the story before. So today's presentation will be a high-level introduction to the company, followed by a run-through of our assets and our finances and our balance sheet before wrapping up and taking questions. Just to introduce you to the team, I'm Brian Larkin, I'm the Chief Executive of the company. Peter Dunn is our CFO.
Morning, everybody.
And Jonathan Leather is our Chief Operating Officer.
Morning, everyone.
We have a non-executive board chaired by Graham Martin, who joined the company in 2018. Graham spent the majority of his career with Tullow Oil, where he was an executive director. Alongside Graham is Iman Hill as our independent director, who formerly headed up BG's group business in Brazil and Shell's business in North Africa. Our strategy, well, we're very much focused on creating as much value as we can for our shareholders, and we do that by maximising the value from our existing asset base and looking to grow the business through high margin opportunities. The company as itself is a strong platform for future growth. We have built an exciting portfolio of assets which have demonstrated value creation both in our balance sheet and also for our shareholders. The industry is facing a lot of challenges at the moment, and to some extent the sector has come somewhat out of favour. But despite the changing market environment, United is very much focused on maximising shareholder value and returns. We have a good track record in this, and in particular I'd point to the experience of our board and our strong corporate governance structure. 20% of our corporate KPIs directly related to ESG metrics. The assembly of our portfolio has also shown our ability to identify high-grade assets, acquire them, and create and extract value from those assets. And John will talk a little bit about that shortly, and Peter will reference that value in our balance sheet. We do have very strict investment criteria to ensure that we are maximising value from our assets. We've also got a strong track record in our ability to manage our capital and our equity. We haven't raised equity in almost 3 years, and during that period we have increased our production, and we've also developed our other assets within our portfolio. On slide 6, I won't labour this slide too long. It's just a brief summary of the history of the company since inception 2015 up to date. What I would draw your attention to is the left-hand side of the slide, where we have just highlighted the director employees and related parties shareholding within the company, and also on the right-hand side where we've put together a graph which demonstrates the oil price performance in a correlation to United Oil and Gas's share price performance. And as you see, there's quite a significant value gap in terms of our share price performance versus commodity price performance over the last period. As a brief introduction to our portfolio, and I certainly don't want to steal John, our Chief Operating Officer's thunder here, but just by brief intro to our portfolio, our core assets are in Egypt, where we have got a production-based business. We've drilled 11 wells in the last 2 years in Egypt and increased production substantially during that period. And more importantly, all of that activity has been funded out of operational cash flow. In the UK, we have a discovery, the Maria discovery, which is located in the central North Sea. We're currently working on a resources report, which we aim to have by the end of this year, before we would then consider our monetization options for that license. Alongside those two key licenses for us, we also have a high impact exploration license in Jamaica, where we have potentially 2.4 billion barrels of recoverable oil. That's a drill ready prospect, and we are in the process of farming that license down to bring in a partner to drill a well there. I'll pass over to Peter, our Chief Financial Officer, to give you a flavour of our balance sheet and our financial performance.
Thank you very much, Brian, and good morning again to everybody. Thank you for taking the time to join us this morning. The slides I just put up here, the financial information is taken from our annual reports for the last number of years, and it really is just to give some financial context to how the company has developed over the last number of years, and how really the Egyptian acquisition in 2020 was transformational for the company. As you can see, over the 4.5 years, last 4.5 years, the company has generated cumulative EBITDAX of nearly $21 million. I think when you put that in the context of the acquisition cost for the Rockhopper asset, or our Egyptian Abu Sinan asset, of $16 million, you can see that the operations from Egypt are not only cash generative but actually very profitable, and it's very good and quick return for that investment. And I think as John will speak to a lot better than I will, the asset is in a better place now today, even after our 2.5 years of production, than it was 2.5 years ago. So we've added significant value. Not only have we extracted cash and extracted value, but we've added value, so that the long-term value of the asset is, as I said, in a better place. I think what I wanted to we've also shown that we have continued to invest in the asset, and we've spent $13 million of capex, predominantly in Egypt, over the last number of years, and that is to deal with the dual priorities of any company, which is not only to maximize the short-term value of an asset, but to maximize the longer-term value, and which will obviously, we expect, to deliver value to shareholders over the short and medium term. I think what we can see also from these balance sheet numbers, I think it's very important to emphasize, is that we have delevered the balance sheet. So when Brian and John and the guys did the acquisition a number of years ago, there was a debt and equity split of 50-50. And over the time, we have delevered that. So we repaid that facility with BP. And at the end of next year, we'll be fully, that facility will be fully repaid. So that obviously means that there is significant unutilized debt capacity. And we will look to that over the next number of months and over the next year or so, to see how we can refinance that and look at putting longer term finance into an asset that will go on for a number of years and will continue to produce cash flows for us for a number of years. So I think the last 4 years we've really seen that improved balance sheet strength, and we do most certainly have a very stable cash flow platform that we can use and leverage to deliver value in not only the short term but in the longer term. Chair, maybe if we move on to the next slide. I've just pulled out some of the key numbers in our H1, and for those shareholders who are familiar with the story and have been on the most recent calls, we've gone through this, but I thought it's just worth highlighting a couple of points. In particular, we are exposed to the oil price. So unlike some assets in other jurisdictions, we actually get the oil price. We realize the value of that uplift in commodity prices that we've seen. And in the first half of the year, we realized over $105 per barrel, and that's very important. I think it's worth noting that the fiscal terms in Egypt are very good and compare quite favorably to fiscal terms across the world. What is different to maybe the UK or the North Sea is that it's not a tax and royalties regime. It's what's called a production sharing contract. And basically what that means is that the Egyptian state tax, or the Egyptian return, the return to the Egyptian government, comes off the top line. So rather than having a tax and royalty number further down your balance sheet or your income statement, it comes off the top line. So the tax return for the Egyptian state is circa 57%, 56-57%, and our net is 42.5%. And that's how the Egyptian gets the return, and there's no further taxes to be paid either in Egypt or in the UK. I think what we've seen is we've increased our cash balances over the last year, and as shareholders will be familiar, we had a modest cash balance at the end of 2021, and that has increased throughout the year. Notwithstanding, we have received proceeds from disposals, but the cash, we have generated significant cash in Egypt. We have invested some of that cash, and we continue to invest that cash in both operational CapEx, that's maintenance CapEx, development CapEx, but also CapEx in relation to exploration wells that we believe will deliver long-term value. I think it's worth noting that we are operating in Egypt, which is a low-cost operating cost environment. The operating cost per barrel compared to other countries is very low. And partly because, well, primarily because we're working in an onshore desert environment. Our operating costs are circa $8, which compared to other operations is a very lean and efficient cost base. And I think finally, I just want to mention, we are delivering strong operating cash flow, $6.4 million, over $6 million in the first half, and we expect that to continue into the second half. And finally, just the final slide is a bit of an overview, and it's more just to give a certain amount of context. We recognize we are a small cap business. We have less than 20 million market cap. However, we believe we have very much a grown up and our capital structure is a very grown up and well defined capital structure where we have strong cash flows from our operating assets, which have delevered and improved our balance sheet. We have achieved excellent results from our portfolio management. And we have, as I mentioned earlier, not only do we have a current debt facility with BP, which is very important to us and could be very important to us going forward, but we have that latent debt capacity within the asset. What this means is that we can generate that cash and that operational cash flow. That allows us to maximize our ongoing production. It allows us to engage in significant CapEx for development CapEx and also exploration CapEx. But what it also does is it gives us the Egyptian business, which is the engine of our financial performance, provides us with the cash flow to support our other assets. So it allows us to support our activity in Maria, which obviously we believe will deliver significant value in the future, and also supports our endeavors in Jamaica. On top of, obviously gives us a certain amount of war chest, if you will, to go out and look for inorganic growth, which is an important part of our overall strategy. So hopefully that gives you a brief snapshot on the financial history of the business and our current strong financial position and our plans going forward. And with that, I might hand over to my colleague, John.
Thanks, Peter, and hello, everybody. So I'm going to talk about the portfolio and the assets that United hold in a bit more detail. But before getting into those, I did want to say a few words on ESG, or environment, social and governance. It's something the company does take very seriously across our entire business. And I think that's still reflected in the fact that 20% of our corporate KPIs are made up of ESG metrics. Now, there are many aspects to the topic. Often the focus is on the environment, particularly emissions, but as well as working to ensure that we have well-established best practice governance practices in place, we also do a kind of work to develop the communities in which we are present. We primarily do that through funding capacity building programs. An example of that would be the Al Amal program aimed at graduates in Egypt. We also work to limit the group's impact on the environment, and we have completed studies on emissions in Egypt and also on the carbon intensity of any development should we have an exploration success in Jamaica. So something, as I say, we do take very seriously as a company, something I wanted to say a few words on before getting into more detail on the assets. On the assets themselves, and starting off with Egypt, which is our producing asset. In Egypt, United hold a 22% non-operated stake in the Abu Salam license, which sits in the Western Desert area, onshore Egypt, and approximately just 2 hours to the west of Cairo. The license is operated by Kuwait Energy Egypt, and it's been in production since 2012, meaning actually at this stage there is a long history of producing from the asset and a very experienced experienced team in country. The license itself contains 8 producing fields with 21 wells spread across those fields. And what that means is that it provides a robust production base, meaning that we're not over-reliant on any single field, or indeed any single well. And the license is delivering around about 1,500 BOEs per day net to United. Now, although the license has been on stream and on production for coming on to 10 years, there does remain significant upside potential on the license. And that's both through development of the existing fields. You may have seen an announcement yesterday about the Ash 4 development well and a positive test result from that well into one of the existing fields there, but also through exploration. And when you look at the map on the slide here, the white area surrounding the fields, that is an exploration area of the license where we have identified a portfolio of exploration targets. And when you see that the historic exploration success rate on this license has been close to 80%, much of our exploration, these are near field, low risk exploration targets. When you then look at the fact that it's a low cost asset, we're looking here at it is onshore, the wells are shallow, they typically very short drilling time, so the net cost to us tends to be less than $1 million net. We're also covered once these wells come on stream, the operating costs typically around about $8 per barrel. So that means that the targets that we have here, whether development targets or exploration targets, are economically attractive, and perhaps not surprisingly, we are actively getting after those targets. So when we look at what's still to come from the license, you can see that through a combination of development drilling, which is primarily aiming to maintain and materially enhance production, and exploration drilling, where we're looking to grow reserves and secure acreage, there's a potential to add significant value over the years to come on the license. I mentioned already, but we announced yesterday morning a positive test result from the Ash 4 development well, which tested a maximum flow rate of over 2,000 barrels of oil per day on test. And the rig that drilled that well is now going to move to drill the high-impact ASW-1X exploration well, which is targeting, on a gross basis, 8 million barrels. And when we say high impact, to put that in some context, net to us, that's nearly 2 million barrels. And our reserves at the end of last year were 3 million barrels. So should we have the success that comes in here, that does materially enhance the value that's on the license there. It's also worth pointing out that the exploration targets we're talking about here have benefited from recent reprocessing of data, which has really improved the quality of the subsurface imaging. And much as ASW-1X is one of the largest remaining prospects in the license, it isn't a standalone prospect by any means. We have a large portfolio of prospects across that exploration area that I showed on the previous slide, over 30 identified prospects, all of which benefit from the low-cost nature of the asset, meaning even small volumes here discovered can be commercially attractive. Indeed, when you look at the bubble plots on the chart here, which shows those exploration targets, you can see the minimum commercial fields are lying there, and the fact that the vast majority of these targets lie well to the right of that line. And again, when you look at the fact that these are low-risk targets, and it says historic exploration success rate around 80%, and these are attractive targets. And as you can see at the base bottom here, that the drilling program just completed the Ash 4 development well, moving on to the ASW-1X well. We are expecting a very active drilling program to continue into next year. We're expecting to see a good balance of development and exploration wells. And given exploration success, particularly with materiality of prospects like ASW-1X, we do see the potential to significantly increase production levels from the current levels, and that's shown in the bar chart there as we move into the years ahead. So that's Egypt, and then moving on from Egypt to the UK, Central North Sea, where United hold 100% of the Maria discovery. The Maria discovery contains around over 6 million barrels of high-value resources. The reason we prefer them as being high value is that they lie very close to existing infrastructure. You can see how close Maria is on the map there to the existing Piper field, and also to other activity. There is development activity ongoing at the moment around the Marigold Yeoman development hub just to the north of Maria. The committed technical work program, which was technical studies including rock physics and seismic conversion, has now been completed on the license, and that has had positive results not just for Maria, but also from the additional prospectivity that lies on the licensed area. We're now in the process of finalising an independent contingent resources report, and we very much expect that to support the volumetrics that we have calculated and estimated for Maria. And we'll get that completed then ahead of the forward plan, basically assessing and making sure we optimise the forward commercialization options for this asset. And that then brings us on to Jamaica, which is a frontier exploration license, Walter Morant Basin, offshore Jamaica. It's a very large license, over 22,000 square kilometers, covers much of the offshore area to the south of Jamaica. There's not just the fact that it's large. For a frontier opportunity like this, there are all the signs we want to see to indicate there is a working petroleum system are in place here. We see active hydrocarbon seeps, very good reservoir and seal candidates, and we see a number of large structures. So we're now at a stage as well where we have been working over a number of years, which have shown that, but has also delivered an excellent data set. So when we refer to this as a world-class exploration opportunity, you know, it compares with anything globally in terms of this type of frontier opportunity, the positive indications that are there, and the data set that exists. And indeed, we're now at a stage where we've mapped up on that data. The Colibri prospect is at a drill-ready stage, has been independently estimated to contain over 400 million barrels of recoverable resources. And the next stage, United currently hold this license at 100%. The next stage really, in order to move forward to drilling that, is to bring in a partner to accompany us in drilling that prospect. Although it was a standalone Colibri is very attractive, 400 million barrels and NPV of close to $4 billion, that is only the start of the potential that's in that license. There's a further 10 prospects that have been identified, included in that independent report, which between them contain over 2 billion barrels. So should we have a success on Colibri, that initial well potentially opens up far more than that 400 million barrels, giving us potential to access over, you know, multi-billion potential there. The license also benefits from a very supportive and positively engaged government. We were awarded an extension to the license that started this year for 2 years, and when we've been in country, we've had the opportunity to meet with both the Minister and the Prime Minister of Jamaica and talk them through our activities and the progress that we've been making on the license. We're continuing at the moment with technical work program, which continues to provide additional positive evidence for the offshore prospectivity. And in parallel to that, you know, we are working actively to facilitate the evaluation of the asset from potential farming partners. When we look at the fact that, you know, we're looking at an increasingly positive market environment, you know, where there's increased focus on energy security and high commodity prices, and given the figures and the positivity that we've seen from all the indications on Jamaica, it's not surprising that we are seeing significant interest in the opportunity. And then just to finish up with a summary of what's still to come and some value catalysts that are coming over the next 12 months or so. On the top line in Egypt, we've just completed the Ashford development well, moving on to the very exciting high-impact ASW-1X exploration well, and then expecting a very active program next year, which will include a balance of both exploration and development drilling. In the UK, we surely expect to be completing the contingent resources report on Maria, and we'll then look to evaluate all the commercialization options. And in Jamaica, studies and farm-out efforts continue, and we look forward to providing a further update once we're in position to do so. And then in addition to all this activity, it is worth pointing out as well that, you know, the team does continue to evaluate new venture opportunities. And we have got a great asset base, but we are also looking to do what we can to add to that and have further value from additional opportunities that might be out there. But in summary, great asset base and lots of value-adding activity still to come. With that, I'll pass back to Brian.
Thanks, chaps. Just in terms of the summary and wrap up, we've covered quite a lot in a short period of time, so very happy to take any questions shortly. But just to wrap up, we feel that we've got all the ingredients in place to continue the growth of the company. We've got proof of execution that we can execute transactions, we can execute work programs. We've got proof via that execution that we can create value from our assets and grow our asset base. We have a very strong team in place, which I think the output of our work over the last number of years demonstrates the strength and capability of the team. And the next steps for the company is scaling up. And there's two ways to scale up, inorganic and organic. When we talk about organic growth, we talk about scaling up the existing asset base, creating value from the existing assets, whereby we execute our work programs in Egypt and look to increase our production there. Also moving forward our Maria discovery into a with a resources report so that we can look at our monetization stroke commercialization options and also driving Jamaica forward. Alongside that, then there's an organic opportunity via acquisition and scaling up the company by adding more assets into the portfolio at the right time, but also more importantly, the right assets. I think at this stage, we're very happy to take any questions. I think a number have been submitted already, so please do, if anybody has any further questions, please do submit them.
Brian,
Thanks, Brian.
Peter, Jonathan, if I may just jump in there, absolutely, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Brian, Peter, Jonathan, as you can see, we have received a number of questions throughout today's presentation. And thank you to all of those on the call for taking the time to submit their questions. Sharon, perhaps I could hand back to you to chair the Q&A session with the team. And then if I pick up from you at the end, that would be great.
Great, thank you, Jake. So we have had a number of questions, and I'll read them out and get them answered for you. The first question is, can you talk to the drilling performance for 2022 and characterise that for your expectations and what's being delivered?
Yeah, sure. Thanks, Sharon. So it's been an active program in 2022. We so far completed 4 wells, about to go on to the 5th well. When we look back at what the results of the drilling program were, earlier in the year we drilled the ASD2 development well. That came on stream well ahead of expectations in terms of production rate and has continued to produce above expectations throughout the year. So that well has been very successful. We just completed, as we announced yesterday, the well test results from the Ash 4 well. I think when we look at the results there, I think we're looking again at success that was in line with our pre-drill expectations there. We also had the AJ14 development well, and that was a well that I think, when we look at it realistically, we would have liked to have seen come on stream earlier. We did find net pay in the reservoir there. We had some discussions around the best way to bring that on stream and what we should be targeting and optimizing within the JV. But we are now expecting that to be stimulated over the coming weeks. And when that is brought online, we do expect it to come online at rates in line with what our expectations were for it. But yeah, ideally, I think we would have liked that to have been on stream a little bit earlier. And then we also had the ASD1X exploration well. Now, although that well was not successful in terms of bringing it on stream or adding to production, it did give us a lot of additional information in a key area of the license. And that information will feed into the seismic process that we're doing and will add to potentially further exploration targets in that area. It did demonstrate that hydrocarbons have migrated into what was an underexplored area of the license. So that's the 4 wells to date. And we're now, shortly due to spud the 5th well, the ASW1X well. I think, as I probably said in the slides, that is a very exciting, high-impact exploration well. It's one we've been aware of and looking to drill for quite a while. But with 8 million barrels potential gross, it clearly is a high-impact well. We look forward to drilling that and updating the markets once we have results from that.
Thank you, John. Next question. Can you talk to what quantity of oil production is hedged and what price per barrel?
Thank you very much, Sharon. Well, the board, and myself and the board, we review our hedging policy on a regular basis. We currently do not have any direct oil hedges in place. We do have a hedge in relation to the derivative or the financial instrument we have from BP, which give us an indirect benefit of a hedge, which should the oil price go below $70, the repayments under the facility will drop. So that gives us some level of protection. We do regularly look at the cost benefit analysis on hedging, but given our current level of production and the value that is in synthetic hedges, because we don't actually get the barrels our barrels are sold directly to EGPC, the cost benefit isn't there for us right now. But it's something we consider. We stay in touch with the market to ensure that we're aware of new products, that synthetic hedges that are available, and we'll continue to review that policy. But I said, as of today, there is no direct hedging on our barrels, but we do have that indirect hedge from the BP facility.
Thank you, Peter. Next question. Can you talk to the number of the number of wells planned for 2023, current decline in production for existing wells, and how close are you to selling the North Sea asset?
Yeah, sure. So on the 2023 program, I mean, that is something that, as I say, is still being finalised, but we are expecting to, continue a very active drilling program. At least 3, possibly up to 6 wells. We are looking at options for potentially bringing in another rig as well. So the number of things that we're looking at, I think the key part there is we want to get a good balance of development wells, looking to enhance the production from the assets, as well as exploration, which is not just about enhancing the production short term, but also delivering longer term value and adding to the reserves base of the license. There's a number of other parts there of the question, Sharon.
Yeah, and it was talking about the decline rate for the existing wells.
Oh, yeah, decline rates for existing wells. We don't talk about the decline rates on individual wells. If you do look, we do publish the reserves report. We have that from the end of 2021. It's available on our website. That looks at decline rates from the asset as a whole. And with limited activity, you're typically looking at rates across at 15 to 25% decline rates.
Thank you.
And I think there's a question there about Maria as well.
Yes, and the North Sea and selling those assets. Could you talk to that, please?
Yeah, I think I'll take that, please, John. We haven't made a decision on the way forward for Maria just yet. Now is not the time. We will wait until we have as much information as we can possibly get together and collate before we make a decision on monetization options. The real key piece of information that we want completed is the resources report, which we should have by the end of the year. Once we have that in our hands, we can then look at commercialization options. And there is a number of options for commercializations. There is a straightforward divestment, and there's also a partial divestment where we stay in the asset and participate in a development. And at this stage, it's a little bit early to say which way we will go. I think the outcome of the resources report will help inform our decision. But certainly, it would be attractive to us to consider staying in the license based on what we know right now today. Our opinion on that might change, but certainly at this stage, it would be attractive for us to stay in a development of Maria.
Thank you, Brian. There's a number of questions on the Jamaica farm out. What is the progress there? And is there anything else you can tell us?
Maybe I'll take that one, and I can ask John to chip in a bit. We're very limited in what we can say on that process, unfortunately. We do have significant interest in the project. We are under confidentiality agreements with a number of parties, and we believe in the project, and we do believe that we will bring in a partner, but it's not going to be quick. We've always said that it's going to be a long road. These projects, by their nature, are quite long lead times. And in addition to that, it is a new country entry for any new counterpart or any potential partner. And it does take time to get counterparties comfortable with new country entries into Jamaica. So we believe all the ingredients are there for a really strong project, but we just have to be patient. And we believe that the patience will pay off over the longer term.
Yeah, absolutely. I mean, I think the one thing to add to that is just, with particularly this year, we have seen increasingly positive market environment in that, I said it on the slides, but the focus on energy security, the realization that actually to meet future energy needs, there is going to be a need for investment in this type of new country exploration opportunity. And we are seeing that combined with the high commodity prices feeding into the strategies of particularly larger companies. And that has led to, a significantly increased interest in Jamaica. And we are engaging a number of people on that at the moment.
Thanks, John. Next question. Could you talk to what percentage of revenue in Egypt is paid in Egyptian pounds? And the second part is, how much is the company currently able to transfer out of Egypt in US dollars?
Thanks, Sharon. Well, maybe just backing up on that a little bit. All our revenue is denominated in US dollars, so we invoice in US dollars. EGPC under the contracts are to pay us in US dollars. However, the practice for all oil companies in Egypt over the last number of years, well, basically since I've been working there in 2012, is to accept a combination of both US dollars and Egyptian pounds. That works for the companies. It particularly works for a company like ourselves that are continuing to invest in country to deliver value. The majority of our costs are in Egyptian pounds. I'm afraid I can't go into a detailed breakdown of a split because of US dollars and Egyptian pounds, because it's commercially sensitive. Every oil company in Egypt is seeking to maximize the amount of US dollars that they receive, and I certainly don't want to cause an issue with EGPC, which is the national oil company of Egypt, by stating the percentages that United Oil and Gas are achieving. We do receive US dollars, and we have been able to and continue to be able to transfer US dollars and Egyptian pounds from Egypt. As we noted in our interim statements, there has been some macroeconomic issues that have impacted Egypt, which we believe are relatively short term, which have brought about some challenges around US dollars liquidity, but we have managed through that process. I think it was very important for Egypt as a country that on the 27th of October, the IMF agreed a loan, up to $4 billion loan into Egypt, which is being further supported by other funds from Gulf states of between 6 and 9 billion. So whilst this year has been somewhat challenging from a macroeconomic point of view, following the war in Ukraine, we are seeing some improvement in US dollar liquidity. But it hasn't in any way affected our operations locally, and hasn't affected our operations back in UK or Ireland.
Thanks, Peter. John, what factors do you take into account when deciding if an exploration well is worth drilling?
Yeah, good question. So as well as the operator obviously of the license, we're looking at say Egypt and talking about exploration in Egypt there. The operator do their own work, we do our own technical work. What we're looking to assess is the potential size of the accumulation and the potential risks associated with that, and then we feed that into a commercial assessment to make sure that should we have success there, and on a risk basis, that actually these are going to be value-adding targets that we're going after. I think when we look at some of the wells that have been drilled, the exploration wells we've drilled previously, they were very low-risk wells. The four-way dip closure is very close to some existing fields, with very high chance of success. But then the volumes associated with them, are commercial and going to add value. They're not necessarily needle moving in terms of new reserves. When we then look at something like ASW1X, that is something that is slightly higher risk than say that the historic rates on the license of around 80%. I think we would carry around about 50% exploration chance of success there. But as I talked about on the slides, the volumes associated with that structure are very large. So it's something that we've mapped separately and that we've had discussions on, and something that we are very keen, have been keen to see drilled. We recently acquired or reprocessed data across that structure, which was supportive of the volumes that were there and the presence of that structure. So again, that is now we've just a stage where the next well is going into that, and we're really looking forward to seeing the results of that well.
Thanks, John. And just picking up on that, could you talk about the location of the ASW well and your understanding of the structures underneath?
So ASW, clearly in terms of size, ranks very, very highly across the rest of the portfolio, which is why it has been prioritised with the volumes that are there. Interestingly, it does target a number of different reservoir levels. It's situated to the southwest, about 10 kilometres, 12 kilometres southwest of the ash field. There are AEV targets, which we know to be a very prolific reservoir, but there are also numerous Abu Rosh and Bahariya targets as well, which we will be penetrating pretty well. So again, look forward to seeing what we can find on those multiple wrestlers.
Thank you, John. Next question. Could you talk to the share price and the value gap in that share price?
Sure, I'll take that one. The share price performance has naturally been extremely frustrating, not just for our existing shareholders, but also for my team. A lot of hard work goes in to build a portfolio and to maximize value from the assets, and to not see it in the share price is usually frustrating. I think what's extremely important for us is that we continue to make the right decisions for the business. That's crucial. We can't make decisions to get a bump in the share price. We have to make decisions that are the right decisions for the asset over the longer term. We always remain confident that the cream will rise to the top, and we'll see that value reflected in the share price. We have taken quite a lot of action this year in terms of media engagement and shareholder engagement, particularly investor relations engagement, including quite a number of new investor roadshows, investor calls. Example of the call we're on today. We've held many investor meetings and potential new investor meetings throughout the course of this year. We've also changed our broking team to bring in potential new investments into the stocks. But it is difficult, it's hard work, but you know, there is a value gap, that is correct, and the value gap, and we are aware that there's quite a lot of people on the call today who haven't heard the story before, but the value gap is essentially a buying opportunity too. So we will continue to run the business the right way and to make the right decisions by the assets, and have faith that the share price will catch up with us and will reflect that value.
Thank you, Brian. Could you talk to the production in Q3 and the new Ash 4 well and the production on that?
Yeah, I can take that one. Look, in terms of the production in Q3, we gave an update on the production levels at the end of September. Much as we do have an initial test result from the Ash 4 well, we do want to wait for that to come on stream and see the rate at which it's producing stabilise. And once we have a stabilised rate from that well, I think that would be the appropriate time at which to update the production levels.
Thank you, John. Next question. Do you consider that having a production base in a single country is the best way forward for a junior E&P, or would a second production stream improve the portfolio's attractiveness and risk aversion?
It's a really good question, and I guess to answer it kind of in two parts. Firstly, we have to start somewhere, so we have to get a production asset somewhere, and Egypt made sense, and I think the deal we've done in Egypt, we've been validated in that acquisition, and that we have increased production. We have funded our entire company on the back of Egypt. We've created cash. So I think Egypt has been a really good acquisition for us. The next stage of our development is obviously continuing to grow our production in Egypt, but also to look at opportunities to bring other assets into the portfolio. Now, it makes sense for us to look in Egypt to add more assets to the portfolio, because we know that we have a team there in place in country. But certainly we are opportunistic, and for the right deal, be it outside of Egypt, we'd certainly consider it. Peter's already mentioned that we have some optionality around our financing structures, and that we've got an asset that, you know, the value of that asset has increased substantially since we acquired it, which means that its borrowing capability has increased substantially since we acquired that asset. We also have a strengthened balance sheet. So Peter's already alluded to a war chest building, and certainly we feel that by leveraging the existing business coupled with our balance sheet, that we are in a position to move should we identify a acquisition. There is very few deals that get mentioned or announced that we haven't seen. And one thing I'm very pleased about is that we're not missing any deals that come to market. In the last 12 months, we have signed 30 NDAs. We've been in 18 processes, but we have declined to move forward on a number of all those transactions because they haven't met our high and strict investment criteria. But certainly does make sense to diversify risk across our portfolio, and we will look to do that. But the most important thing for us in any acquisition is that it's the right deal, structured and financed the right way. And that means being patient. And I'm not the most patient man in the world, but I have to be patient to make sure that we we only go after the right deals for our shareholders.
Thanks, Brian. Those were all the questions that were submitted. Should we just give a moment in case there's any further questions?
Sharon, if I may just jump in there, and Brian, Peter, Jonathan as well, thank you very much indeed for addressing all of those questions that came in from investors this morning. And of course, if any further questions do come through, we'll make these available to you immediately after the presentation has ended for you to review, and then add any additional responses, of course, where it's appropriate to do so. Brian, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that would be great.
Yeah, I really just to thank everybody for taking the time today to join the call. If anybody does have any follow-up questions, please do submit them to the company. As I've mentioned, we're aware there's a number of people on the call who haven't heard the story before, so if they want anything else further clarified, please do make contact with us. We always endeavour to respond to any queries or questions that are submitted as quickly as we possibly can. But otherwise, just thank you to our existing shareholders for their continued support. It is appreciated and it's not taken for granted. And thank you all for your time this morning.
That's great. Brian, Peter, Jonathan, thank you very much indeed for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected, for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of United Oil and Gas PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.